What's happening, y'all? I'm Mike the Money Motivator. Today in this video, I'm gonna give y'all a tutorial on how to invest your money. This is how to invest your money for beginners. If you're new to my channel, make sure you like and subscribe. I talk finance and reviews every week on this channel. If this is your first time hearing about investing, the purpose of investing is to allocate your money in an area that can duplicate your money over time, to grow for you for a later date. The investments I'm going to talk about today are specifically retirement investments, money that you just continuously put a little portion of money in at a time, but consistently over a long period of time. The reason why investing in the future is so important because with inflation, prices and everything go up. And when you get older, you won't be able to work. You're going to need money for that time that you can't work. But things will also cost more at that time. So you're going to need money for inflation and you're going to need money because you can't work anymore. Investing is not something that you have to break the bank on. You just got to be consistent with minimal investments. And I'm going to show you how in this video. The first investment everyone should have if you work for a company is a 401k or a Roth IRA. With your 401k or Roth IRA, of course, you want to max the contribution that your company is offering. So if your company is matching your contribution up to 4%, then you make sure that you continuously put 4% into your 401k. I have another video on the 401k. Y'all check that out if y'all want more information on the 401k and the Roth IRA. That should be the majority of your investments. But your 401k Roth IRA may not be enough. So the first thing I want to talk about is stocks, bonds, ETFs, and REITs. Everything I just mentioned is all on the stock market. You can invest in the stock market through a brokerage account like Fidelity, Robinhood, Charles Schwab. In my description, there'll be a link for investing platforms where you can get money towards your initial investment when you sign up. So investing in the stock market. Investing in the stock market is buying fractional shares of a company that you could expect to continue to grow over time. So when you invest in a stock, you want the company to be very stable, like Apple or Coca-Cola. That way you're sure that you'll gain returns on those stocks. Investing in stocks, you'll see a ticker symbol, and that's basically just an abbreviation of what the stock is called. The price you see associated with that sticker symbol is what the current price is. Over a long period of time for almost any company, the price will increase. Whatever price you initially purchased the stock at is basically your base ground for your investment. For instance, if Apple is $100 per share and you invest $20 in that $100, you're buying a fractional share, but you're also locking in that starting price of an average. So when you continuously buy stocks, as the price goes up, your average does increase. There has been stocks in the past to not grow up over a long period of time. So investing in a stock is not a guarantee that the price will go up over a short period of time or a long period of time. You need a lot more education than what you'll get in this video to invest in individual stocks. But the greatest investor of all time, Warren Buffett, that invests in individual stocks, actually recommends that everyone invest in an index fund or ETF tracking the S&P 500. I have those same beliefs for the average person. The S&P 500 is a bundle of stocks of the top 500 businesses on the stock market. If a company happens to fall out of that top 500, then they'll be replaced by another one. It averages 10 to 12% a year. The ETF is more balanced. If you pick one stock, there is a risk for loss. But if you pick an ETF, it'll have so many different companies to perform better than other companies at different times. The stock market and the S&P 500 is basically compounding interest. You're not investing a significant amount of money at one time. You're investing small portions of money over a long period of time. So investing $10 a week in the S&P 500 is way better than waiting 3 to 5 years until you get better off on your feet. The most important part of investing is when you start and not how much you invest. Now, investing in ETFs, if you want to invest outside of the S&P 500, ETFs, they do have expense ratios. You want to make sure that the ETF has a low expense ratio, definitely nothing over 1%. The expense ratio is basically the fund charging a little fee for the ETF that they made. Expense ratios over a long period of time will eat at your profits. So you want to make sure that your ETF or index fund has a low expense ratio. Another investment on the stock market is REITs. REITs are real estate investments, and most REITs, they pay a monthly dividend. And what a dividend is a company actually paying you as they grow over time on a scheduled basis. So REITs, they usually pay a dividend every month. My favorite REIT is O Realty Income. It has a diverse portfolio of real estate, and the dividend is somewhere around 25 cents per share. As you grow the amount of shares that you get over time, of course, your dividend will get bigger when you have more shares of the asset. REITs aren't the only thing that pay dividends, but they're the only thing that pays dividends on a monthly basis. As a beginner, you should dollar cost average every time you get paid. Even if it's $5 a paycheck, you should dollar cost average in the S&P 500, and that should be the majority of your portfolio. It could even be 100% of your portfolio, but no less than 60%. So you have REITs on the stock market. You can also invest in real estate on a crowdfunding platform like Fundrise. In another video, I'll go over Fundrise. Investing in Fundrise, your money isn't as liquid as purchasing a REIT, but it is investing in a group of diversified investments. As the tenants are paying their monthly payments, you get dividends that accumulate, and you get paid dividends quarterly. If that sounds interesting to you, I'll make another video on Fundrise, giving you a review on Fundrise. Cryptocurrency, I think, should be a part of everyone's portfolio. Cryptocurrency is a decentralized asset. Because it's not centralized, prices significantly fluctuate. So cryptocurrency should not be the largest portion of your portfolio because of the unpredictable fluctuation. Me personally, there's only 2 cryptocurrencies I pay attention to. I invest in Bitcoin, I invest in Ethereum. I leave the rest alone. If you're just extremely in love with cryptocurrency, maybe 30% of your portfolio should be crypto. But really, I don't even think it should be more than 20. To invest in crypto, you need a platform just like to invest in the stock market. And the platform that I use for crypto is either Binance or Coinbase. In the descriptions, I have links to both of those where you could get money towards your first investment. Next investment I want to talk about is life insurance. Life insurance is really important for people that have a family or have kids. In the event of you passing, the death benefit that's paid to your family members, so it's very important if you have kids. But another tool that people use for investing in life insurance is collecting a dividend. A whole life insurance policy that pays a dividend pays you as you go with the policy. On the flip side, whole life insurance policies do have a high premium. Another famous life insurance investment that's famous is infinite banking. In another video, I'll go over infinite banking in detail. It's basically investing in life insurance and at a later date taking loans against the policy. If you want to invest in wine, you can invest in wine. You can go on Yield Street and invest in artwork. You could even invest in the metaverse on OpenSea with cryptocurrency. You can invest in so many different things. Another investment is taking equity out of your home. Over time, your home price builds equity. As the value of your property increase, you can take a loan out on your home to invest in a business or an investment to make you more money. I only recommend something like that for more sophisticated investors, someone that knows what they're doing. Outside of that, just leave your house alone, pay it off as soon as possible. Now I'll give y'all my formula on which assets I prioritize and which percentage should you put to each asset. The assets that I prioritize is the stock market, real estate, cryptocurrency, and insurance. Real estate, if you don't want to invest in a REIT or Fundrise, just make sure that you buy a house. You buy a house, you'll eventually pay it off. Your mortgage is the biggest bill. Once you get rid of it, it's gone. That's one way to secure your future in retirement, is to not have any bills to pay. So real estate is a priority, mainly buying your home. If that's all you want to invest in, at least invest in purchasing a home with real estate. As far as diversifying your portfolio, invest in the S&P 500 weekly or bi-weekly. That should be somewhere around 70% of your portfolio. Your real estate is your home, or if you want to purchase real estate investments to get you a recurring income, then you do that as well. But if you want to limit it to your home, I'm okay with that. You'll pay it off before you pass. Life insurance is important if you have kids, a wife, niece, nephew, anything like that, right? Life insurance is really important. Plus, a dividend helps. I do feel like it should be a part of everyone's portfolio, whether you're doing infinite banking or not. Bonds are something that are recommended to increase the amount of your portfolio as you get older. If you're in your 30s, 30% of your portfolio, 40s, 40% of your portfolio, and continuing like that. However, I'm not convinced that bonds are worth your money. I've been looking at the bonds performance lately, and I'm not really seeing any great return. So for right now at least, I don't have any bonds in my investment except a very small portion in my 401k. So cryptocurrency, meaning Bitcoin or Ethereum, I think should be no more than 30% of your portfolio. If you like both of them equally, 15 and 15, if you like one more than the other, you know what I'm saying, you diversify that how you want to, but Bitcoin and Ethereum, no more than 30% of your portfolio. That's it, y'all. I hope this video was very beginner friendly, and if you have never heard of investing before, I hope this was helpful. Investing is important and should be done in small increments over a long period of time for you to build wealth, even generational wealth. I hope I didn't miss anything. This video was off the top of the dome. I usually write a script. I'm Mike the Money Motivator. Y'all make sure y'all like and subscribe. Also, let me know if y'all have any ideas or topics y'all want me to cover.